Welcome to StockTok's deep dive into Brookfield Corporation. Brookfield is a global alternative asset manager and holding company that operates across real estate, infrastructure, renewable energy, and private equity, managing hundreds of billions in assets for institutional and individual investors worldwide. As of May 1st, the stock is trading at $45.23. The 52-week range runs from $35.95 on the low end to $49.57 on the high end, placing the current price roughly in the middle of that range. The Relative Strength Index, or RSI, sits at 57.3, indicating neutral momentum, neither overbought nor oversold. The 50-day moving average is at $42.51, while the 200-day moving average is at $44.71. The stock is essentially trading between these two key technical levels. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Brookfield Corporation operates as a global alternative asset manager and diversified holding company with a presence across real estate, infrastructure, renewable energy, and private equity markets. The company's core competitive advantage rests on its ability to source, manage, and monetize long-lived, cash-generative assets on behalf of institutional clients, pension funds, sovereign wealth funds, and high-net-worth individuals. Revenue is generated through management fees, performance-based carried interest, and direct operating income from its underlying portfolio companies. Now let's look at the StockTok score. Brookfield is rated 23 out of 100, a clear avoid signal. The breakdown is sobering. Valuation scores just 3 out of 20, financial health scores 8 out of 20, profitability scores 1 out of 20, growth scores 3 out of 20, and smart money positioning scores 8 out of 20. This is not a balanced scorecard. Multiple dimensions are flashing red. Now, valuation. The question every investor has to answer: are you paying the right price? Let's start with the price-to-earnings multiple. Brookfield is trading at a trailing 12-month P/E ratio of 91.74 times earnings. That is extraordinarily expensive by historical standards. However, and this is critical, the forward P/E, looking ahead to next year's expected earnings, is only 15.8 times. That massive gap tells us the market is pricing in a dramatic recovery in profitability in the near term. The P/E ratio, which divides the earnings multiple by the growth rate, stands at 5.36. A P/E above 2 typically suggests valuation is stretched relative to growth prospects. At 5.36, we're significantly above that threshold. The enterprise value to EBITDA multiple is 14.42 times. For context, the asset management sector has historically traded in the mid-single digits on this metric, so 14.42 suggests premium pricing. The price-to-sales ratio of 1.39 times is moderate by technology and financial services standards, but the real red flag emerges when we examine the margin of safety. Our analysis suggests the stock is trading at a 509.57% premium to intrinsic value. In other words, you would need to pay 509% more than what the fundamentals suggest the company is worth. That's an eye-watering valuation premium. Regarding competitive moat, Brookfield does possess genuine moat characteristics: switching costs in its client relationships, scale advantages in capital deployment, and strong intangible assets in its brand and operational expertise. However, these advantages are priced to perfection in the current valuation. Wall Street analysts have a consensus mean price target of $54, with a high target of $63 and a low target of $31. That's a wide range of opinion across 10 analysts, suggesting disagreement on the fundamental case. The most recent quarter reported revenue of $20.16 billion against an estimate of $77.66 billion. That miss is striking. Actual revenue came in at less than 27% of consensus expectations. The company reported operating income of $5.16 billion, net income of $740 million, and revenue growth year over year of 6.5%. The stock surged 1.1% after hours on these results, suggesting the market was either relieved by the outcome or pricing in positive forward momentum. Despite the positive price reaction, the revenue miss cannot be ignored. News sentiment around Brookfield leans bullish, with market analysts highlighting it as a compelling investment opportunity among holding companies and dividend stocks. However, that analyst bullishness stands in stark contrast to the deteriorating fundamentals and the massive valuation premium. From a valuation perspective, the setup looks stretched to us. Yes, the forward PE is more reasonable, but the path from today's profitability to next year's expected earnings would need to materialize perfectly for the bull case to hold. Moving to financial strength, how solid is the foundation? We start with the Piotroski F-score, a 9-point financial health checklist developed to identify financially robust companies. Brookfield scores 7 out of 9, which on its surface appears solid. However, this score masks serious underlying stress. The Altman Z score, a model designed to predict bankruptcy risk, is 0.47. Anything below 1.8 is in the danger zone. 0.47 indicates severe financial distress. The company's cash-to-debt ratio is 0.09, meaning for every dollar of debt, the company holds only 9 cents of cash. This is razor thin. The interest coverage ratio, which measures how many times operating earnings can cover interest expense, is just 1.06 times. An interest coverage ratio below 2 indicates the company is barely able to service its debt from operations. Any downturn in earnings or a spike in rates could create a refinancing crisis. The current ratio, a measure of short-term liquidity, is 0.85, below the healthy threshold of 1.0. This means current liabilities exceed current assets, signaling potential near-term cash flow stress. Most alarming, the debt-to-equity ratio is 5.42. For every dollar of equity, the company carries $5.42 of debt. This extreme leverage is typical of financial engineering and holding companies, but it leaves almost no margin for error. The balance sheet is heavily dependent on asset appreciation and successful portfolio management to remain solvent. From a credit perspective, Brookfield is walking a tightrope. The leverage is extreme, liquidity is tight, and profitability is insufficient to generate strong debt service capacity. This is a high-risk capital structure. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 2.77%. Return on invested capital measures how effectively a company deploys shareholder capital to generate returns. A return on invested capital below 5% is generally considered weak. At 2.77%, Brookfield is destroying capital efficiency relative to its massive asset base and leverage. The gross margin is 24.15%, the percentage of revenue remaining after direct production costs. The operating margin is 24.04%, nearly identical to gross margin. This suggests the company has minimal operating leverage. Selling more units doesn't meaningfully improve profitability once overhead is included. The net profit margin, the percentage of revenue that flows to the bottom line, is just 1.73%. Think about that. Out of every $100 of revenue, only $1.73 reaches net income. This is anemic for a business managing hundreds of billions in assets. The free cash flow margin is negative 5.05%. The company is burning cash relative to revenue. That's unsustainable. In the most recent quarter, the company reported operating income of $5.16 billion on revenue of $20.16 billion, translating to an operating margin of approximately 25.6%. However, net income of only $740 million implies the vast majority of operating income was consumed by interest, taxes, and other charges, a direct consequence of the heavy leverage. The profitability metrics are deeply concerning. Yes, the company can generate operating income from its asset base, but the path from operations to net earnings is clogged with debt service and cost structure issues. Return on equity is 2.78%, and return on assets is 0.26%, both abysmal for a company with this much capital deployed. Brookfield is not converting its enormous asset base into shareholder returns efficiently. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is negative 6.3%. The company has been shrinking. Over the trailing 5 years, revenue growth is positive 5.3% annually, meaning there was contraction in the most recent 3-year window. That's a deceleration flag. The company appears to be facing headwinds in a growth phase of the economic cycle. Book value growth over the trailing 3 years is 5.7%. Book value, the net asset value per share, has grown modestly, but well below what we'd expect for a global alternative asset manager in an inflationary environment with rising asset prices. In the most recent quarter, the company reported revenue growth year-over-year of 6.5%. That's a re-acceleration from the 3-year trend, but a single quarter of growth doesn't erase the multi-year deceleration. The dividend yield is 0.55%, extremely low for an investor-focused holding company. Typically, asset managers and holding companies yield 2 to 3% to reward patient capital. Brookfield's minimal dividend suggests the company is retaining cash to service debt rather than return capital to shareholders. The growth picture is weak. The company is not expanding at a meaningful rate. Profitability is under pressure, and free cash flow is negative. Without organic growth, the business model relies entirely on asset appreciation and successful financial engineering to maintain returns. That's a fragile setup. Now let's talk smart money. What institutional capital is actually doing with this name? Brookfield is held by 17 top-tier institutional investors tracked by Dataroma. However, the behavior of these holders is telling. Josh Tarasoff at Greenleaf Lane Capital holds the stock as 18.93% of his portfolio, a massive concentrated bet, but he has been reducing the position by 1.04%. Bill Ackman at Pershing Square Capital Management holds 18.15% of his fund in Brookfield, yet he's been reducing by 0.21%. Chuck Acker at Acker Capital Management, a legendary value investor, holds 13.51% of his portfolio in the stock, but has been cutting the position aggressively by 6.87%. Stephen Mandel at Lone Pine Capital is one of the few showing conviction. He holds 5.37% and added 4.26% to the position. Third Avenue Management holds 4.57% and reduced by 3.39%. The pattern is clear. The largest holders are quietly exiting. Only one meaningful holder is adding. That's a red flag. Among the broader universe of 13 F-filers, institutional money managers with more than $100 million under management, only 4.3% are net buyers. For context, anything below 50% is considered net bearish. 4.3% suggests institutional money is indifferent to hostile regarding this name. Insider ownership is 0%. Management owns almost no stock. That's alarming from an alignment perspective. When management owns nothing, they have no skin in the game and can walk away. There have been 0 insider buys and 0 insider sells over the past 3 months, complete radio silence from company leadership. That's not a vote of confidence. The smart money setup is deeply negative. The largest holders are exiting, institutional flows are net bearish, and management owns nothing and is trading nothing. This is a red flag for the thesis. And finally, the verdict. Let's bring it all together. On valuation, Brookfield is trading at a 509% premium to intrinsic value with a trailing P/E of 91 times and a margin of safety that is deeply negative. The forward P/E of 15.8 times is only attractive if the company can deliver a sharp earnings recovery, a bet we're not confident in. On financial strength, the Altman Z score of 0.47 signals distress. Leverage is extreme at 5.42 times debt to equity. Interest coverage is barely above 1 times, and cash coverage of debt is minimal. The balance sheet is fragile. On profitability, return on invested capital is 2.77%, free cash flow margin is negative, and net profit margin is anemic at 1.73%. The company is not efficiently converting its asset base into cash or returns. On growth, the 3-year revenue trend is negative 6.3%, though the recent quarter showed 6.5% year-over-year growth. The trajectory is mixed at best, and the dividend yield of 0.55% offers minimal income. On smart money, the largest holders are reducing positions. Institutional flows are net bearish at 4.3%, insider ownership is 0, and there have been no insider transactions in 3 months. The smart money is exiting. The latest earnings results showed a significant revenue miss against expectations, though the stock surged briefly on the quarter. That positive market reaction masks the underlying deterioration in fundamentals and the fact that the company's revenue came in far below consensus. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. The setup at Brookfield warrants caution. The valuation is stretched, the balance sheet is stressed, profitability is weak, growth is decelerating, and institutional insiders are exiting. This is a name that may face significant headwinds. That's the deep dive on Brookfield Corporation. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.